Hey there! Lots of people hate taxes, and it seems unfair when you make small money and still need to pay lots of taxes, what's publicly saying they don't pay any taxes. Some rich dudes like Robert Kiyosaki and Donald Trump have openly talked about paying taxes, and you might be wondering, how can they publicly talk about paying less taxes, maybe even less than you, all, while we know that not paying taxes is illegal? Why doesn't the government do anything to make these rich people pay more tax? You might have heard about some people and companies who were arrested for not paying taxes. So what's the difference between those people and these rich dudes? They don't pay taxes. Well, rich people have smart ways to pay less or even no taxes at all. There are two main ways to taxes: tax evasion and tax avoidance. Section 1. Tax evasion. Tax evasion is when people break the law by not paying the taxes they owe. This means lying to the government about how much money they made so the government doesn't know about it. This is illegal and can get people into serious trouble. Let's break down how tax evasion works. The first trick is underreporting income. This means they tell the government they made less money than they actually did. Let's to buy a house from John for $700,000. If the tax rate is 10%, they would need to pay $70,000 in tax. But to save money, Bob and John agree to lie about the price. Bob still pays John $700,000. Meant the house was sold for only $500,000. This way, they only pay $50,000 in taxes instead of saving $20,000. This is illegal because they are lying about the actual sale price to avoid paying the full tax. The second trick is hiding assets. This means people hide their money in places where the government can't easily find it. For example, Switzerland was famous as a tax haven. A tax haven is a country with very low taxes and strict privacy laws for people to hide their money there. Usually, banks have to report information about their account holders to the government so that taxes can be collected properly. But Swiss banks were known for their secrecy and didn't share information about account holders with other countries' taxes. So, if a rich person puts their money in a Swiss bank account, their home country's government won't know about it. Here's how it would say, Tom, an American, earns a lot of money but doesn't want to pay high taxes on it. So, Tom opens a bank account in Switzerland. Swiss banks keep this information secret. Tom doesn't report this money to the United States tax authorities, the IRS. By this way, Tom avoids paying taxes on this income. This is illegal because Tom is lying about where his money is and the tax authorities. However, this has changed as lots of countries began pressuring Switzerland to share information about account holders authorities in their home countries. So, if a rich American hides his money in a Swiss account today, the bank would report this to the IRS and would be arrested. The third trick is false deductions. This means people or businesses lie about their expenses more than they actually are to reduce their taxable income and pay less tax. For example, imagine Sarah earns $100,000. If you have a business, the government allows you to reduce your tax burden to help your business grow by business income first, reducing the amount of taxable income. So, if Sarah earns $100,000, instead of her 20% of $100,000, which is $20,000, the government lets her spend some of that money on her business first. Renovated her restaurant for $30,000, she'd only pay 20% on the remaining $70,000, which is $14,000. But Sarah wants to pay less tax and keep more money. So she renovates her restaurant for only $3,000, but falsely claimed $1,000. This reduces her taxable income to $70,000. Now she only pays 20% of $70,000, plus her actual renovation cost of $3,000. Her total spending is $17,000. By inflating her, it reduces her taxable income, pays less tax, and profiting $83,000. If she had been honest and spent the full $30,000, her total spending would be $44,000 and just get $56,000 the rest. So, the point is, should have spent $30,000 on renovation, just spent $3,000 on the renovation, and corrupted the rest $27,000 to IRS that she used the whole $30,000 to reduces her taxable income. In summary, tax evasion legal methods that break the law and can get you into big trouble. So, it's really important to remember not to try these at home. There's a legal way to pay less in taxes, called tax avoidance. Section 2. Tax Avoidance. Using smart legal strategies to pay less in taxes. It's like finding little loopholes or taking advantage of tax deductions and allows. While tax evasion can lead to fines or even jail time, tax avoidance is considered clever financial planning. In the law, you're just using the rules to keep more of your money. Let's break down how tax avoidance works with some examples. The controlled foreign corporations, or CFCs. A CFC is a company set up in another country where taxes are very low, known as a tax haven. By doing this, people can move their profits to this foreign company to avoid paying high tax. A real-life example is Apple. Yeah, the company that makes the iPhone and other electronic stuff. Apple avoided paying taxes, about $44 billion in just 3 years from 2009 to 2012 by setting up shell companies. Shell companies was called Apple Corporation Euro in Ireland. This company didn't have any employees, but it was incredibly beneficial for. How does this shell company work? Ireland's tax laws recognize a company's tax residency based on where the company's moved. On the other hand, U.S. tax laws recognize tax residency based on where the company is incorporated. At this difference. By creating a company in Ireland, the U.S. didn't tax the company because it was incorporated in Ireland. But having management control in the U.S. instead of Ireland, Apple avoided Irish taxes. The second trick is transfer pricing. Transfer pricing is when a company moves money between its branches in different countries. It sets prices for things like products or services to make in places with low taxes. This way, the company pays less tax overall. For example, let's say John has a Wee Shoes Corporation in the United States. His company just sold a new model of shoes and made $1 million in income. Assume the U.S. corporate tax rate is 35%. Normally, he would pay $350,000 in tax and keep $650,000 profit. But instead of paying this 35% tax, John decides to use a tax haven like the Cayman Islands, which has 0%. So John sets up a subsidiary in the Cayman Islands called Wee Shoes Cayman Islands Corporation and transfers all the corporation's patents and copyrights to this subsidiary. When the U.S. Wee Shoes Corporation sells a new model of shoes, it claims it needs to pay $800,000 to the Cayman Islands subsidiary for using the Wee brand's patents property. This leaves only $200,000 in the U.S. to be taxed at 35%. So, the company only pays 7 U.S. taxes and no taxes in the Cayman Islands, keeping $930,000 in profit after taxes. This saves John $1,000 in taxes. However, John can't bring this $800,000 from the Cayman Islands back to the U.S. without paying taxes on it. John can reinvest the money outside the U.S. or wait for tax reform. For example, in 2018, tax rate changed from 35% to 21%. If that happens again, John can bring the money back to the U.S. at the lower tax rate. To bring back the $800,000 at the new 21% tax rate, he would pay $168,000 in taxes, keeping $630,000. This way, John ends up with $762,000 after taxes, compared to $650,000 if he had paid a percent tax. The third trick is using dividends. As I mentioned before, Warren Buffett, one of the most successful, pays a lower tax rate than his secretary. How does this happen? Well, because his income mainly comes from dividends and long-term, not salary. Dividends and long-term capital gains are taxed at lower rates compared to ordinary income. For instance, $1,000 salary might face a tax rate of 22% to 24%, $100,000 in qualified dividends and capital at just 15%. This tax advantage allows Buffett and other wealthy people to pay less in taxes on their income, which are treated more favorably by tax laws. In summary, tax evasion is illegally avoiding taxes by lying, while tax avoidance is using legal methods to reduce or even avoid tax bills. While tax evasion is risky and tax avoidance can be a smart way to handle your finances within the law and provide benefits. It's also important to note that some think our tax avoidance are actually tax deferral. Tax deferral means you are just delaying tax payments but still mount eventually. For example, contributing to 401k retirement accounts, using 1031 exchanges for IRA and others. These strategies delay taxes to a later time, unlike tax avoidance, which aims to reduce the If you want me to make other videos explaining these topics, please like and subscribe. Thanks for watching.